Good afternoon, smarthelping.com here, and I've got another quick update on a very important metric for the SaaS business in general at a high level. All these key metrics are very important to understand if you're running this type of business, and they should be focused on in order to increase efficiency and total value. Before I get into it, remember to like and subscribe if you're on YouTube, and there will be a link in the description box below to purchase this template. So it's actually pretty simple. We've got the customer LTV, which is lifetime value, and the customer acquisition cost. Two very important things, which is saying how much does it cost the company to acquire a new customer, and what's the total value of that customer over time. And that's all we want to know. So what I did is I'm just going to walk through the whole template because it's pretty short, and I'll tell you what the update was from what it used to do and what it does now. So first, you start with user input. So you're going to put um, current monthly recurring revenue users. So say you have 7,000 users that pay a monthly fee. The total monthly recurring revenue dollar amount that all those users are paying together. And then a formula will calculate the average revenue per user. You then want to enter the monthly cost to service users. What this means is like cost of goods sold and any costs that are directly related to allowing customers to operate on your platform. So this is mostly going to be like it could be customer support if it's directly if they're just there to help onboard and they're a required cost. It could also be hosting fees for website and different platforms, whatever is essentially monthly recurring expenses that are directly related to being able to have customers continue to operate on your network. And so after you figure out that, you've got a gross margin, and then you can calculate the actual gross recurring revenue per user. So this is the money that you're earning per user before, and then the only thing that comes out of that is then more your operating expenses, non-related to servicing customers or users. So this is like your earnings. This is the true earnings of a customer or of a user. Then you've got one-time inputs, so one-time revenue inputs. So if on average you get $10,000 of one-time revenue and it costs 3,500 to apply that, let's say that could be a setup of an account, and you pay 3,500 as a one-time onboarding to staff that help get the customer locked into your platform or whatever it does, and you don't need to keep paying that, doing that every month. You got a gross profit here, and then you divide that by the total. You divide that by the total users to figure out what your one-time revenue per user is. And that's actually divided by your total users added per month. And no, I'm going to say users and customers. It means I'm talking about the same thing. It's the same. So just note that. But some of the terms like customer acquisition cost, acquisition cost, normally you see it listed as customer. So that's just what I'm putting. But for ease of writing descriptions, I've used the term user, but it's the same. So then so we know how much we're earning per user per month. We know how much one-time revenue we're earning per user when they onboard. So now you enter staff, sales staff, and marketing spend. So sales and marketing is the key to um, how you're acquiring customers. That's your main cost. So you divide that by the total average customers you're adding a month, and you get a customer acquisition cost average. And then, so that's one of our key inputs for the calculation. And then based on this recurring revenue and this one-time revenue, we go over here and you can see these calculations automatically pull in, and then you've got a retention rate here. Let's say right now it's 75%. So that means you're losing a quarter of your cohort every year. So what we do is just reduce or we say that the average customer length is 4 years in that case. Essentially, the calculation would be uh, to get to 4 would be, let's see, you do 1 minus this, which is a quarter, and then the 1 divided by the actual churn gives you 4. So if our average retention rate was only 25%, now you can see we only last essentially that saying after 1 full year, um, there's no more users. And this is done on a yearly basis, not a monthly. So you're not going to get, it's going to be, whole numbers for the lifetime value. And this just multiplies the monthly recurring revenue by 12. The gross profit, this is of one-time revenue and recurring revenue. And so the one-time revenue is year 0, and then after year 1, that's going to be 12 months of recurring revenue for however long the estimated life is. And then we're just discounting that back based on a discount rate to figure out the present value, and that's what we're calling customer LTV, which is a sum of all of these columns. Let's say your retention rate was 95%. Now, essentially, that means your last 20 years. You can see it goes all the way out to year 20. And the further out, the less it's worth today. And depending on what your discount rate is, and all you're doing is trying to compare that value to what it costs today to add the customer. And that's how we're getting our ratios, and I'll get into that in a second. Let's put this back to where it was, which was 75%. So 75% customer lifetime value is 3,390. So if you go back over here, that's where we're getting this number. And then the first big ratio is LTV to CAC ratio. So that's how much is the total value against the customer acquisition cost, 6.2. A good number is, they used to say you can go public at around 6 or 7, but like anything above, I think 4 is good. And this just means, how much bang are you getting out for your buck of a customer to spending on adding customers. The bigger the ratio, the better. That just means the value of the customer over their life is really high compared to how much it takes to add them. Let's say you're spending a ton. What if your monthly compensation for staff is 100,000 and you're only earning, so that puts your customer acquisition cost to 2,050. Now your LTV to CAC is down to 1.7, which is, again, it's below 4. I feel like that's super low. It means that you're barely, the total value of the customer over its life, the present value is barely bigger than your spend to add the customer. So you're spending a lot, you're not getting a lot out of the customer. The second metric is the total month it takes to now pay back that cost based on how much one-time and annual revenue or monthly revenue, recurring revenue you're getting. Here, it's going to take to pay back $2,050 of a CAC, it's going to take 22.4 months. And I'll show you that calculation is just doing your total CAC minus the upfront one-time revenue, so 1920, and it's dividing that by how much monthly gross profit you're earning here. See, there's 22.4. That's how this is calculated. So this should be a good number for payback is like anything under 5 or 4. You could essentially say 4 is the magic number here. You want your LTV and CAC to be above 4, and your months to payback CAC below 4. And that should give you a pretty good. That should be pretty good targets. But again, you can define your targets however you want and justify them however you want. But this calculator at least shows you what inputs you can look at from your metrics of your operations. Plug the numbers in here real quick and see what you get, and then you can track it over time. You can, post what your numbers are each month, and it will change over time based on, this number changing, the revenue changing, whatever your spend is, one-time stuff. All that stuff can change month to month, and you should be tracking it. Um, let's put this back down. Let's say you barely spent anything on marketing. Let's say $1,000 for staff and like 500 for this. Here it's saying now you're actually making more. Your LTV to CAC is 113, and you're actually making more in month one when they join, which is in the one-time revenue. That's higher than the actual CAC, so you've got a negative. I mean, if this is negative, that's obviously a good thing. It's not bad, uh, but it's hard to get there. You basically have to be able to add a lot of organic users without spending much money to get this to negative, and you might not be able to scale like you want if you are doing that. It just depends. Every situation is different. I think this is at 10,000 originally. Can't remember. It doesn't matter though. So, but you just adjust the yellow cells. All your formulas update. LTV will update accordingly, and that's the model. Now, I believe this template here has a ton of value for any SaaS business, especially a startup that really is trying to figure out where to focus their management and energy and where they're trying to optimize. This is a very good place to start. And investors will be wanting this information from you. So getting these numbers to be good is a good thing. All right, that's all I got for you today. And I'll be streaming on Tuesday. We're going to be looking at inventory within the three statement financial model.